Afternoon. Today is Tuesday. On Tuesdays, I'll be here at 3 p.m. to talk about a shorter topics. So typically we run that maximum 30 minutes, but we give you solid knowledge. Today we talk about pros and cons of holding real estate in C corporation. Yes, there's a lot of talk about that. People use C corporation to hold real estate for all kind of reasons. So now let's just talk about what could that be, pros and cons, and what you should do. And keep it in the LLC or making it a C-Corp, and it's all up to you, right? So now let's talk about our, the couple slides before the real knowledge sharing. That is our website. And you can go to our website, communitycpa.com, and on our website, you can become our client without clicking anywhere else. Go to onboard with us. When you start uploading your information, on our end, we have specific persons waiting for you to see your documents to come in and to start contacting you. Then the onboarding will start. So that is something we want you to know. And our firm, we're pretty amazing. And what you want to know, we have like 12,000 clients, more. And we have 6 different branches. And we really do, we have a bunch of professionals, like about 48, 50 of us. We are really into helping you. I say this with real meaning, not just because, oh, that's your corporate slogans and that's what you do as a privately owned business. No, we are privately owned business, but we are really the one with the heart for our community. So you will feel that way when you work with us. And here is our YouTube channel. Our YouTube channel has been there for 5 years, and we consistently putting in 4 videos a week since 2020, March 28th. That's exactly the day we started, and then we never stopped. So watch our video, and we have a lot of content to share with you. And I want to also bring to your attention, Community CPA, we sponsor an event called Immigrant Entrepreneur Summit. Go without saying, it is an event made for immigrant entrepreneurs. So if you are an immigrant, if you are an entrepreneur, and you should be the one coming to the event. So you can go onto website, take a look. This is a nonprofit organization, and Community CPA has been sponsoring this nonprofit since 2008. So long history. And the event has been here in Des Moines, Iowa for more than 18 years already. So it's not new, but yet every year has renewed energy goes into it. No responsibility disclaimer that's related to our webinar today, and making sure that you check out the knowledge and verify everything I said. So that is the only way for you to be better than me. And you verify everything I say and challenge me. I love that. Okay? Overview of C corporation. A C corporation is a separate legal entity, and it is a separate tax entity as well. The corporation, not the owner. The corporation holds the title and the asset, holds the real estate, and makes the income and pays for taxes. See? Everything is the corporation, not you, not the shareholder. And the owner, the shareholder, only receives the profit through dividend distribution. Of course, you are a shareholder, you work in the corporation, you may get a W-2, but you really receive the good news through dividend distribution. The important thing to understand the dividend distribution is that you don't have to distribute dividend to yourself if you don't need the money. A lot of times our folks will say that, oh yeah, it's double taxation and I don't want it because I'll have to pay taxes twice. One time at the federal, at the corporation level, that's 21% flat, right? So our personal income tax rate is not 21% flat. It is actually from 0 all the way to 37%. So it's not flat, but corporation tax is flat. When it is flat, you pay taxes once you got profit. Then you got left over after taxes, you pay dividend. But the thing I want to mention to you is you don't have to. You don't have to distribute dividends, especially privately held C corporation. Okay, so of course you heard things about this accumulative earning taxes, 20%. So this is the penalty that the IRS giving to the C corporation when you got so much of return earning in there, you have no plan. So can you give me an example of you have monies in your pocket, you don't have plan? You have plan. As long as you have a reasonable plan and you can have dividend in your company, there is no requirement for distribution. So the reason I say that double taxation is in theory, but in reality, you don't have to have double taxation. You can always use up your retained earning by investing in more property purchase whatsoever. Why real estate in a C-Corp? So why some people and wanting to put real estate in a C-Corp? Sometimes business place the real estate inside of a C-Corp for liability protection. Because it is a separate entity, it is separate tax-paying entity, it is not the shareholder, so it is a completely different person, right? So for liability protection, for ownership continuity, what does that mean? So if you have all your properties inside of C-Corp, and then you want to admit new owner to come in, you don't have to go through changing titles on all your property like that. No, you just have the person be admitted to be a shareholder, go through the shareholder acquisition steps, not going through all your properties, right? Corporation also have a huge amount of benefit cleaning you can do. So those are reasons. Often people choose to have a C corporation because the C corporation has this autonomy. It's not really, it's not related to anybody, and it is on its own, right? It can be used for both operating the real estate and also investment of real estate. You can use that to hold title, you can use that to invest, you can use that to rent. So C corporation is all encompassed. You can do everything you want to do. Now, let's look at the pros of holding real estate in the C corporation. So that the C corporation is a separate legal entity, which means that the shareholders' personal assets are protected from the business debt, right? You could borrow a lot of money to buy a property inside of C-Corp, but your personal end of things, as long as you didn't use that for personal guarantee, right? Then you separate all your lawsuit and all your claim related to your properties in the C-Corp. It's not related to you. Liability exposure is drastically limited to a corporation asset. If it is corporation asset, you have that protection, okay? You also want to know that it's particularly valuable and for commercial property within, with the tenants or customer exposures, to have that under C-Corp is just very beneficial because the liability is very much controlled, all right? So with that said, you want to see C corporation holding the property as one of the big advantage is liability protection. And transfer of ownership is also get easy because the ownership of C Corp is represented by shares, right? Number of shares. You got 100 shares, I have 100 shares, so we're 50% shareholder for that C corporation. So this, because of the share ownership, allows the smooth transition when selling, gifting, or transferring ownership interest. So no need to re-record deed and going through counties each time your shareholder changes. And that for ease of estate and the succession plan as well, just because everything is under C Corp. For example, if you are a C Corp shareholder, you have 140 properties under C Corp. Then you go to the law firm, you go to the lawyers and say, oh, I want a living trust. I want living trust. So what the lawyer do? They change the shareholder to the living trust instead of redo all your 140 deed for you. Otherwise, you would have to do that when you are trying to put your property under the living trust. So simplified, bringing new investors, business partners without, disrupting the property titles and the finance. Every time you have these kind of changes, if you change the deed, you have to go to ask the bank permission if you have a loan. So you better have all your property are paid with your own money. Otherwise, it's not even easy to transfer the deed. But with corporation setup, yes, you can. Pretty simply. Potential fringe benefit for owner-employee. So this is related to if you have the C-Corp, you are running the real estate business and you pay yourself a salary, oh yeah, you can have a lot of benefit to there from the health insurance deduction all the way to your retirement plan, pay yourself a salary. There's just so many common things that made available to business owner would be magnified under the C corporation. You can make that happen. And life insurance, Keyman life insurance, you can buy it for yourself. All of these things. You can also purchase life insurance to cover the debt you have in the C Corp in case you die and the debt will be paid off. So those are benefits for the C Corp. And retained earnings and the reinvestment potentials. You know how when you have a C corporation, you finish paying taxes, then you have this retained earnings sitting on your book. That is your piggy bank for reinvestment. So this is where you can visualize clearly how much of investment you can do. When you go to bank to do financing, they also look at your C corporation financials, looking at how is your ownership equity going, what is your retained earning, and then bank can comfortably loan you based on that. So with a lot of benefit on investing without getting complicated, just the C corporation itself be the collaterals and be the one borrowing money and had made things a lot more simpler for you when you have them all under one roof. It also allows the deferral of individual taxes if the profit remained in the corporation instead of being paid out, right? So obviously when you made 21% of corporation tax payment already, you have the left after tax left over, which is called retained earning. And that amount on your book, you can pay out for more benefit you wanted. And then you also can buy properties, and then you can do other investment. If you say, oh yeah, I want to do crypto investment, you can do. Because you have a C corporation, you can open up brokerage account, do stock tradings as you want, right? So once you set up a C corporation as a stock trading account, it is automatically marked to market. So you can actually write off and increase income or write off the losses without you actively buy and sell and your stocks because you are marked to market. So with that said, there's a whole bunch of possibilities for C Corp to work the amazing things for you. And the centralized management and the formal structure. This is another reason why real estate gurus are actually put their real estate properties and management into C Corp, because that gives them a centralized management from the depreciation of the property all the way to how to pay out labors and how to collect the rent, how to do reinvestment, upgrading of the building. All of that is centralized. So this is where the benefit of running real estate business under a C corporation and a formal structure just pertaining to when you have a corporation, you have the board of directors, your shareholder. So maybe you both are shareholders. So maybe you both are the chairs of the board. Then you can have other people coming in to help you guide the operation. You have the formal structure that is already have a blueprint from the past. Any C corporation running that way, and then you can follow those structures and really get your business process screen through the proper procedure and making yourself perfect in the process. deducting expenses, no need to say. If you have a C corporation, expenses are deducted. So anything you want to pay out, anything that is necessary, reasonable to your business, you already deducted. So by the time you come up with profit, that's a real profit. That is not a profit you go, well, actually a lot of those money I don't even have because I spend here and spend there, is not allowed to deduct this, not allowed to deduct that. There's just so many not allowed deductions. But in here, and you can say that if you have a real estate operating business as a C Corp, the deduction is much more than just repairs and maintenance. And you can deduct employee benefit, and you can deduct continuing education, and you can deduct the medical expenses. So there's so many things you can deduct. You can deduct the mileage, you can deduct the vehicle, you can deduct the home office reimbursement that to your employee, whoever works at home. So with that, they give you a lot more flexibility to do. So, that is on the deduction side. Once you have an income, you have deduction, the leftover is the amount you pay 21%. Just know that our 21% rate is very low, much lower than what the personal side is. If you put your property under LLC to manage, you have a self-employment tax to pay as well. So now at C Corporation, you pay 21%, but on the other hand, with LLC, not only you're gonna pay income tax on higher percentage, probably 28%, then plus 15% self-employment tax. So your tax burden is a lot more heavier if we just compare one scenario and using the same scenario where in C Corp or in LLC, you can end up paying double of the taxes that you otherwise would pay into the C Corp. So folks will say that, well, Ying, if that's what you're saying, why is most of the people are in LLC, they're not in C Corp? Good reason why they're not in C Corp. So let's look at the cons of holding real estate in a C Corp. So it's not all perfect. So the con for holding real estate in the C Corp is that the most significant drawback of using C Corp, it is being taxed twice, possibly, right? If you already pay 21% of taxes, then you distribute dividend to yourself, that dividend is 20%. So your total taxes is 41% if you just add them together. So there is a double taxation. But is it really doubled so badly? Not at all. It is maybe a couple percentage more than what you otherwise pay, but the thing is you don't have to distribute dividend. It is not required, and as long as you have a plan for your dividend, privately held business don't need to worry about dividend distribution. All right? So if the property is sold later, the capital gain is taxed again when it's distributed as a dividend. So what it says to us is that, let's say you got a property. You sold for $100,000 and then your capital gain is $100,000, let's say. You got the property for zero. Let's say $100,000 gain you got. So you're gonna pay 21% on that $100,000. But if you want to take the $79,000 home, after you pay the 21% of taxes, you would pay the 20% of dividend. So this is what we're saying, the double taxation, you pay it twice, but really, unless you really enjoy to pay it twice, and nobody really go on to pay it twice. And taxable transfer of real estate. That is another cons for having the property in the C Corp. Because generally speaking, transfers are taxable event in C Corp. So if you have a property in C Corp, you say, oh, I am mom, I'm going to transfer the house in the C Corp to my son. That is not a transfer. That is a taxable event. So you basically need to sell the property at the market value, fair market value, and then the company recognized gain, then the kid can have that property as the basis, as the fair market value as the basis, right? So if the C Corporation distribute properties instead of cash to the shareholder, the IRS treated it as if the corporation sold the property at a fair market value. So this is where, in general, what I want you to take home with this slides is that whatever you do inside of C corporation is arm's length. Like it is not it is not you. It is another company, another entity. So whatever you do with your C Corp is an arm's length transaction. It's buy and sell. There's no such a thing about under table. You just take it. Okay? But is it possible for LLC to do that? Yeah, LLC don't have to treat everything as taxable event. So with that said, C Corp, straightforward, always taxable event. It's a selling event. But that doesn't mean that you will pay taxes, right? Some of the property drop in value. The fair market value was less than what you bought for. Then when you sell, you have a loss. So it's really a fair game, right? So you just want to remember the C Corp is a separate entity, it's a fair game. If you want things to come out of the C Corp, sell it. That's what that is. And IRS also said that it need to be sold at a fair market value. IRS didn't say it has to be sold more than what you got for. Didn't say that. The IRS just said to be a fair market value. All right. So, what else? What else that makes C Corp not attractive? C Corp is not going to give you the losses like some of the pass-through. You got a negative K1, reverse your income. Wow, you got a lot of tax refund. C Corporation is a separate entity. So it's like a basket, not a basket, it's like a bottle with water. It doesn't come out, it stays in there. So I always say that what happens in Vegas stays in Vegas. So that's just kind of how C Corp is. So if you have a loss, you're not going to be deducted on your 1040, but it will be waiting for your future gain. So inside of the C Corp, the losses you accumulated will be meeting the gains of the future. Then you offset them. You don't have to pay taxes for a long while, right? So this is what people don't like C Corp because they have losses. They're like, I cannot even use the losses. But what if your C Corp close the door and you have overall losses in the C Corp? Do you lose that? No, you don't lose that. If you are a shareholder of that C Corp and your C Corp has accumulated loss that you could not use before, and once you close the C Corp, you can use it. Yes, if you want to know what that is, and you can literally go to our YouTube channel and search for section 1244. So that way we come out to explain to you what that is. But like I said, you don't lose the losses you accumulated in the C Corp. It's still yours. It has your name tag on it, as long as you are the shareholder. Okay, so C Corp, not so attractive because they also don't have capital gain rate. You know, in our personal tax return, your income tax could be 37%, but your capital gain rate is only 20%, right? So in C Corp, no such a thing. It's just all regular income, 21%. So no such a preferable rate. But who cares, right? Because you have 37%, C Corp has 21, flat rate. The more money you have, the more benefit you're going to get on the flat rate. Okay, set up in basis does not apply the same way. The step-up basis does not apply in the same way. The step-up basis is a concept of estate. So let's say if your mom and dad has a building, they passed away and they send it to you. And then the building, they maybe bought it for $1, but at the time they die, and then maybe the building worth $3. Then your step-up value for that building, as you're the child, and it will be 3. And between the 1 and the 3, that gain is a step-up value as long as it didn't go over the estate threshold, which is 13-point-some million right now. Then you don't have to pay taxes. So as a child, you don't have to pay any estate taxes for your mom and dad because you just got a step-up value, $3. Then maybe you decided to sell it right away. Then you sold it for $3. Then you're going to get the $3 for free, no capital gain. Because you got a step up value. So your base is 3, you sold for 3, and you get a gain of 0. That is what we're talking about. In a C corporation, when shareholder pass away, the corporation's property does not receive step up value. No, it still stays the same. Okay, so that is what they're talking about. The stock receives a step up, but the property remains at original price. So in the C corporation, your C corporation itself has a value for your stock. Of course, the value is impacted by how many properties you have in there. But the step up on that value is only on the shares and not on the property. But really, if you work the math through, and if you are digesting the whole C corporation and selling one property at a time, and get rid of the property inside the C corporation, the overall effect coming through will not be so much different from you having that property under your name and running all the high taxes throughout the year, and then when you die and have this step-up value. So, the math is more about, do you care about right now, or you are imagining the future? In tax world, I always advise our folks, you don't imagine the future. You don't tell me that 20 years later, when you get into the retirement age, the tax rate gonna be higher. Don't even go there, because that may not be true. You don't know what crazy stuff a president can do with their executive orders. So just live for today. Whatever rules we have right now, apply to that right now. If it can save you money right now, don't need to go that far into the future. I believe in fate. If I select a method, then ended up paying more taxes, oh well, paying more taxes. But the methodology is you want to think about today. If you can save $5 today, don't worry about saving $50 when you retire. And you're in your 30s, you retire in the 70s. Are you kidding me? 40 years? We don't know what the tax world gonna be in 40 years. So this is the step-up value concerns on the C corporation is one of the most famous resistance in the system when someone says, no C-Corp because I'm not gonna have a step-up in value when I die. It's a lot to think about. When are you going to die? You're in your 30s. I don't think we are in the society, we're in the time people die randomly, without getting to the normal age. Most of the people are getting to the normal age to die, right? Additional state and local tax considerations, that's also key because you want to make sure that you consider that local state taxes can play a role in the C corporation. C corporation do have separate rules with separate state. All right, final remark. When you come to what tax structure is the best for you, what is what is the best for my situation, it is an open-ended question. Based on the taxpayer, based on your specific situation, the answer could be different. So if you are interested in knowing how other real estate professionals handles their tax structures, putting their property where, check out our YouTube channel called Golden Triangle Real Estate Tax Structure. All right, and this is our website. You can check out our partners and to get your answer, your question answered. And this is our last slide, which tells you where to call. And our phone number, 515-288-3188, operates 6 days a week. We open 8:30 to 5:30, Monday to Saturday, all year round, so 6 days a week. We're not typical, and we're a bunch of workaholics, so we work on Saturdays when our folks have time. So I will see you calling our numbers, and I will also see you checking out our videos and subscribe to our channel. Okay, folks? I'll talk